Hello, and welcome to the latest episode of Fixed Interests. My name's Richard Hunter, Chief Credit Officer here at Fitch. Today I'm speaking with Justin Patrie, Head of the Fitch Wire team and author of our quarterly Risk Headquarters report. Risk Headquarters is a quarterly report freely available on fitchratings.com outlining the main risks that we see to global credit, particularly the key risks that we feel could have the most negative impact on credit ratings over the next 2 years. So, Justin, without further ado, what are the key risks this quarter?
Thank you very much for the introduction, Richard. As you said, the Risk Headquarters report is where Fitch looks at global credit from a top-down, risk-focused perspective. And every quarter, we examine macroeconomic trends, political risks, financial markets, and the bottom-up work done by our rating analysts to come up with what we believe are the biggest risks to global credit, which we call key risks. And so for this quarter, we have four key risks, and they are one, real estate, and that includes both commercial and residential. Two, geopolitics, governance, and policy risks. Three, China property and macroeconomics. And four, rates, asset valuations, and financial stability.
Okay, that's a fair selection there. Could we go a bit deeper into some of those risks, maybe starting off with real estate?
Yeah, so this is a pretty broad risk. Actually, all our key risks tend to be pretty broad, but the focus for the real estate risk really right now is U.S. office commercial real estate, and that's because this is a major asset class, and it's undergoing both a secular transition as work patterns change, and a cyclical demand slowdown resulting from tightening financing conditions and a potential economic slowdown here in the U.S. Now, the valuation declines in office commercial real estate have already been significant, worse than in any other downturn in the past 30 years, other than the global financial crisis. And what's more is our base case is for any recovery to be quite protracted and more protracted than any other value recovery curves in recent memory, including the global financial crisis. So, in short, this is a sector that's going to continue to see rising delinquencies and defaults. Loan credit trends are going to continue to deteriorate at least through 2025. And this is all coming after the market has already shed significant value. So that's our base case. And our ratings across sectors
Mhm.
like corporate REITs, banking, non banking financial institutions, commercial mortgage backed securities, they already incorporate this into our base case and sensitivity case rating expectations. So, what do we mean about this being a risk? Well, given the protracted nature of the downturn and the uncertainties about office CRE exposures, this is really what you might call a known unknown. We know that office CRE is under stress, and we've already accounted for a significant degree of deterioration. But there is still a high degree of uncertainty. There is less visibility on exposures in certain sectors, like small banks. There were several high profile earning shocks among European and Asian banks in the first quarter, for example. And so that's really the level of uncertainty remains quite high, even though we've already accounted for a significant degree of deterioration. The other thing I would highlight, and this is I think particularly critical, is the refinancing conditions in the future. Um, we started the year, for example, with investors leaning heavily toward significant rate cuts by the Fed in 2024, and in just 3 months, those expectations have shifted. So, as the rate expectations shift, the risk profile for refinancing is going to shift as well.
Yeah, I suspect that moves us very much towards what you were talking about in the fourth risk rates, asset valuations, and financial stability.
Yeah, this risk has been featured in our risk headquarters or has been a key risk for quite some time, obviously, because we're going through a monetary policy tightening cycle. So we've seen rates rise over the last 18 months, and they might have peaked, but the effects of those rate hikes in both Europe and the US is continuing to manifest in things like higher borrowing costs, deteriorating asset quality, increased default rates, weakening credit performance. And again, these are part of our base case expectations. And thus far in 2024, markets have performed quite well. Equities have hit records in the first quarter. Credit spreads have tightened. Bond issuance was very strong in the U.S. in the first quarter. Um, but the predication of this market performance on expectations of monetary policy loosening is a big risk should inflationary conditions not enable that to occur. So, we're still in an environment where we're expecting the feed through of prior rate hikes on credit quality, but we're also in an environment where there's uncertainty over the direction of future rate decisions. Now, our base case is for some cuts. I think that's the direction the market has moved. There's no longer
Mhm.
expectations of significant cuts, but those expectations have shifted quite dramatically. Sort of every
Yeah.
month, different inflation numbers come out, or different growth numbers, demand numbers, and so it's that level of volatility and uncertainty, which means that that the risk bias in terms of interest rates and financing conditions and market stability remains weighted towards the negative.
Yeah, no, that makes a lot of sense. If we're looking at other things where uncertainty is high, you mentioned geopolitics as a key risk, and we're obviously all aware of trouble spots in Ukraine, Israel and Gaza, and across the Taiwan Straits. But how do we think about this? It translating in terms of credit.
Yeah, so geopolitics is always an interesting but tricky one when it comes to kind of macro credit risk. So obviously, with geopolitical risk comes big tail risks, low probability but very high impact geopolitical events. The Russian invasion of Ukraine being a really key case example of this. So full scale interstate wars, expansion of regional conflicts, major supply chain interdictions. These things all kind of fall under this key risk. But we're also talking about more middle ground scenarios, less dramatic scenarios that can still have an impact. And I think what this risk is intended to capture is that since the trouble spots have emerged in Russia and Ukraine and the war in Israel and Gaza, and also I think more importantly that the rise of sustained geostrategic competition between the U.S. and China is that we are in a new environment of elevated political risk that we didn't really have to think about in this way, say 5 or 10 years ago. And this can manifest in sudden and unexpected ways that affect specific sectors, or that in turn can affect credit ratings. I think it's also important to acknowledge that it's not just kind of geopolitics, but domestic policy and governance that really matters too. So we saw that with our U.S. rating downgrade last year. Now, the driver of that downgrade was a long-term deterioration in fiscal metrics, deficit and debt numbers, but the erosion of governance was also cited. In our recent affirmation of the U.S. rating, policymaking coherence and credibility remained a rating sensitivity. And it's that policy and governance part that I think is again worth emphasizing because the policy making kind of environment for a lot of countries, particularly in the developed world, has become more difficult. We have a cost of living crisis that's been torqued by pandemic-driven inflation. We've had sort of pre-existing political divisions, and we've had a rise in sovereign debt that's limited policymaking maneuverability. So the risk environment in terms of policymaking is definitely going to be more challenging now again than what we saw say 5, 10 years ago.
Yeah, no, very much so. That said, you say we've been looking at these risks for some time now. Many of them have been flagged on the board. Are there any new or emergent risks that you're thinking about?
Yeah, so in addition to our key risks, in the risk headquarters report, we also draw attention to what we call long-term and emergent risks. So long-term risks are secular or structural changes that can affect credit ratings, but beyond the 18 to 24-month time horizon of the key risks. And we've been looking at things like climate risk and demographic change. We've got lots of reports on this stuff outside the risk headquarters that we try to draw attention to. And for emergent risks, these are new risks that have a elevated degree of uncertainty even beyond our understanding of key risks with a difficult predictability. And that's things like the rise of AI, cyber
Mhm.
risk. And so these are risks that we want to kind of flag attention to that maybe don't require the immediacy of the key risks, but we know these are things that could matter or are very much likely to matter. Climate change being a good example. This is starting to matter, and it's going to matter more going further. And it's not just about policy and regulations and business strategy, but direct operational risks as a result of climate change related disasters too.
Yeah, and as you say, coming through into ratings already in some places. To round things off, we can't let the audience go without some editors' picks. One thing Risk Headquarters does really well is to feature some of the best research coming from the analytical teams. What are some of the things that you've read that you'd recommend to listeners?
Yeah, so this is one of the things Risk Headquarters does is we have links to the sort of the best research that we've highlighted that relate to the key risks. And there's a few reports I've read in the last couple of months that I've really enjoyed. So first is we have a stellar cross-sector commercial real estate report that was published in early April. That's called Global Contagion Risk Growing from Rising CRE Delinquencies and Losses. We've
Hmm.
published a lot on commercial real estate thus far this year. But if you only have time to read one report, this is the one that brings our views together across all sectors and different CRE asset classes. So
Hmm.
this is kind of the flagship report of the last little while. We've also released a new report in the last couple of months on a severe downside stress to China's economy. This one's called China Severe Downside Stress Scenario, Impact on Global Sovereigns. This is a great read on what a very negative growth scenario in China would mean for global economies. And last but not least, we've just launched new quarterly cross-sector credit brief reports for the US and Europe. So these are regional reports that outline our macro credit views and ratings trend analysis from a regional perspective. And I'm a big fan of these because these are particularly useful for readers who want to think about credit from a regional cross-sector perspective. So all of these reports are available to Fitch subscribers through our global website or Fitch Ratings Pro. Yeah, those are my picks.
Yep, no, I fully agree. Particularly with the last one, they're a really nice bridge between where the ratings are going and where the markets are going. So, thank you very much, Justin. That is it for this edition of Fixed Interest Podcast. Risk HQ is at fitchratings.com/topic/risk-headquarters. But to get all of our rating and credit views, just visit the homepage at fitchratings.com.